Gerard is a career I followed for quite some time. I met Dimensional for the first time 10 years ago with a former colleague of mine in the audience, Gary Connolly, and Paul, who was there somewhere. And we've been working with them pretty closely since. So Dimensional have grown from strength to strength in Ireland, but I think globally into one of the largest fund managers in the world, and I think one of the most influential because of how they invest client money. So delighted to have you here today, and I'm going to try and tease a little bit about how did you get here first, then we'll talk about Dimensional. I know you don't like talking about yourself, but we'll do a bit of that, and then we'll do a little bit about Dimensional, and then we'll talk about markets. There's a few things going on at the moment that are probably worth touching on. So if you can give us a little bit about your background, about growing up in Waterford, and your impressive academic background.
Yeah, sure, and I'll keep it brief. I grew up in Waterford, born in the 70s in Waterford, so grew up in the 80s and 90s, then came up to Dublin in the early 90s to go to college, went to Trinity College up here in Dublin, and after that went over to the US for grad school. And so went to California to a place called Caltech and did a PhD in aeronautical engineering over there. And it's interesting, in the US, if you're not a US citizen, it's really hard to work for aerospace companies because all of them require US citizenship so you can get the appropriate security clearance. And I did my PhD, I was funded by the Department of Energy because we were working on some of the basic physics of fusion. And very interesting, but thought that, the work that you do, the joke that I often make is that when you do a PhD, you learn more and more about less and less, until eventually you know everything about nothing. And kind of you don't have a very big impact immediately. So I moved into the world of finance about 21, 22 years ago. And it's been great. It's been a lot of fun. Started at Dimensional. So my whole career has been at Dimensional. Started in the research team there as a research associate. And it's been eye-opening. It's been a lot of fun projects. But I think most importantly, and this was mentioned earlier on, when you sit on the same side of the table as the client, everybody wins. And I think just thinking first, is this good for your clients? Is a really easy way to start making business decisions, and that's Dimensional. So they have a great academic pedigree, but then also very client-focused, which makes it a lot of fun.
Yeah, and obviously it was a bit of a transition into finance. I'm sure with that qualification you could have gone to any sector. I know a mentor of mine when I was in school, I was mad into numbers, but I was also kind of maths really. I wanted to get into, and he was like, well, if you want to go down the finance route, you can, but you should just learn the maths, and the finance stuff is easy. I'm sure coming from your level, the finance stuff was easy once you knew the maths and once you knew the numbers. Yeah,
you got to learn all the acronyms. That's probably the hardest part. But I hadn't had any courses in finance before I started at Dimensional, and so got a few books, read them, and got projects at the firm. And my family, there's nothing like an Irish family to make sure that you're well-grounded, no matter how well you do. And so they would make all sorts of remarks about, how are they letting you run around making decisions over there when you know nothing. But, you learn pretty quickly, and it's true. Once you know the underlying kind of mathematics, then the rest, you start to build on the intuition, and it works pretty well.
But I did hear before that you interviewed with Ken French, so that can't have been, who's a bit of a legend in our circles. Can't have been easy to get through that interview without any investment knowledge.
Yeah, he actually didn't ask me any investment questions because he knew up front. So Ken French, for those folks who may not be familiar, Ken French is kind of an academic. He's been around for many, many years, and he works with someone called Jean Fama, so Professor Fama in French. Fama won his Nobel Prize about 10 years ago in finance, and both of those have been closely associated with Dimensional for a long time. And so he and Jean are kind of all the 3-factor models, the 5-factor models. So all the things that you've kind of heard about for profitability, value investing, all of those things, they came from a lot of their research. But yeah, he was nice. He asked me about my research, and he asked me kind of more fundamental questions, but no finance questions. I hadn't read the finance book at that point. Right. I hadn't gotten the job yet.
And then, so to move forward a little bit, 2017, you got your position now.
Yeah.
There's lots of, I suppose, people in the audience have successful careers, in their own right, but then had to nearly park those, what they were good at, move on to management, move on to business ownership. How did you find moving on from like being a research person to now running a firm and almost having to become a little bit more salesy maybe up here doing presentations?
Yeah, I think it's been the whole process I've enjoyed. So I started off in the research team, and after I don't remember how many years it was probably like 3 or 4, maybe 5 years, I started running the research team at Dimensional. And then maybe 3 or 4 years later, I became the Co-CIO at that time. And then in 2017, became CIO and Co-CEO with Dave Butler. And what I've always found is that you can have the best ideas in the world and great understanding of things, but if you can't communicate them, they're largely useless because nobody else can appreciate what it is and get on board. And nothing really is accomplished solo in industry. Everything's accomplished with a team. And so it's kind of really important to be able to explain and expand on the ideas. What I've also found is that having the background in investing and research on the way up very much helps with making decisions at the firm level, because I would say Dimensional has always been a investment-led and client-focused firm. And so we don't make investment decisions just because it will help bring money in. We make investment decisions because we believe that's the right way to invest. And so having that deep understanding is very, very helpful in terms of how you make decisions about where we're going to deploy resources as a firm, what we're going to focus on, and what type of strategies we'll manage. So myself and Dave, we get along real well. It's been really good to have him over the past 7 or 8 years as co-CEOs together. And so he grew up more on the marketing and the sales side. So it's been a great ride, and it's been interesting problems the whole way along. So it's been the whole thing has been wonderful. Yeah.
And is that how you divide? Is it kind of you take the research side and more business development, or how do you kind of work that relationship?
Yeah, our offices are side by side. Okay. So when we're in the office, we see each other every day. So we talk every day. And then there's 13 global departments at the firm, and the investment departments all report up straight to me. The global client group, the marketing team, HR reports straight up to him. We have a COO, and finance, operations, and IT reports to her, and she reports to both of us. And then the general counsel and the chief compliance officer report to both of us. But I would say everything that we do, we discuss together. And I'm sure lots of folks here have experienced this as you've kind of increased your position in the firm. Kind of the further up you go in the firm, the funnier you get, the more handsome you are, and the less informative people's kind of feedback to you, as people don't tell you suck anymore. And it's important to be able to hear that from time to time. So it's really good to have a peer that you can have just absolute frank conversations, because a lot of the stuff that we will be discussing, you can't discuss broadly before it's done. The investment industry is probably the most heavily regulated industry in the world. Like it's right up there. And so being able to keep things until you have the right disclosure and the right forms and the right registrations and so on close to the vest is just a requirement. So having him has been really, really good. Yeah, I think that much better to do it with someone than without, for sure. Yeah.
Yeah, it wouldn't necessarily work for everybody, I'm sure, that kind of relationship. So it is interesting.
Yeah, I think that Dimensional, it's not about the individual personalities. Like when you think of Dimensional, you might think of David Booth or Rex Fingfield as kind of the founders and so on, but it's more about the firm. And that's what is, in my view, great about the firm, is that it's not about any one person. It's about the entire team, which means that if one person leaves, as an investor, you don't have to worry that much because it's always a team-based approach. So it doesn't work for everyone. It works really well for us, and we have a lot of examples of co-leads of different things. Some firms can't make it work, but we do, yeah.
And just for the audience, I suppose, like some people are investors with Dimensional already, but for those who don't know much about Dimensional, can you give a little bit more about where Dimensional originated from? What makes Dimensional a bit different?
Yeah, for sure. So the firm was founded in 1982, and the founders were folks that had been to the University of Chicago. And if you're unfamiliar with kind of the history of finance and so on, a lot of the great ideas in finance came out of that university in the 60s and the 70s. And so the 60s and the 70s were a time when investment data was first becoming kind of collected in machine-readable form, and people were actually being able to test the data in a more robust fashion. So a lot of people had opinions before then, but they had no data to test the opinion and understand if this view of the world actually lined up with what happened in the world. And so that's when I'd say one of the most important observations in finance came out, and out of the research, is that you can beat the market, but you can't outguess the market. And what that means is that you can use market prices to tell you things about differences in returns across securities and differences in risk, but you can't tell when prices are too high and they're too low. That's a futile effort. And so Rex Ingfield, David Booth, and David Booth is the executive chairman now still, started the firm in '82. And they basically started it with two ideas. One is that let's go to the academic world for the investment kind of acumen. And what needs do clients have? And at that time, if you looked at institutional investors, they had a lot of exposure, diversified exposure to large cap stocks, but no well-diversified exposure to small cap stocks. So it was the very first kind of diversified systematic small cap fund was launched in 1982. It actually still exists, still alive and kicking. And from there, they went global, and then other research came around value and profitability, all these types of things. And so where we are today is we have close to 800 billion. I round up to 800 billion. So even though today it's probably like 780 or some number like that, we have clients all over the world. We have a great business here in Ireland. We've been in Ireland here now for quite a few years. Actually, we have a UCIT lineup that you use, which is over 20 years in the making in Ireland. I think it was launched in '04. And so both businesses in the UK, in Europe, a lot of business in the US, and about 1,600 employees around the world. And so it's been a whirlwind. We manage global equity, global fixed income, and if you look at the equity portfolio, it's probably 45 different countries around the world, fixed income, 20 plus developed markets around the world. And so when it comes to public markets, we probably have the full spectrum of anything that anybody could need in terms of different investment options when it comes to public markets. We're public market focused, long only. But yeah, it's been a whirlwind, and I think that you alluded it earlier on, Declan, which is that when it comes to firms that have a reputation for being systematic, for being very connected with academia, for taking those ideas and actually making them work in the real world, Dimensional is always kind of top of that list in terms of the firms that can do that well globally.
Yeah, and one interesting kind of twist on that as well is like you don't really target the retail market directly yourselves. You tend to do it through financial advisors. Like, why did you go with that approach?
Yeah, we started off with institutions in the 80s. So in the 80s, it was all institutions, no financial advisors. And then in the late 80s was when financial advice, independent financial advice in particular, began in America. And so there was a person called Dan Wheeler. And Dan Wheeler, I think he used to work for one of the brokerage firms and, looked at what the incentive structure was there, which was that you got paid on commissions. So if you got people to trade, you made more money. And of course, doing a lot of trading is probably not what's going to make you wealthy over time. What grows your wealth over time is time in the market, not timing the market. And so it's very important to become a long-term investor. So he looked around, he said, you know what, I just don't like this. This is not good. This is not good for the end client. This is not trying to make money for the end client. It's trying to make money for the firm. So he approached David and said, here, I have an idea. And at the time, David said, well, we deal with institutions only, but we'll give you a shot. And so then that's when the independent financial advice business began in the US. And it kind of started as asset allocation and then turned into what was talked about earlier, which is financial planning and kind of more holistic financial planning and how the asset allocation and the investments help you achieve your goals. So our view, where we've evolved to, is we think that the combination of independent money manager, of financial advisor and end client is a really good combination, because the independent financial advisor, typically a fiduciary for their end client, has to choose the best money manager that they can. We don't make payments to any of those. We don't pay for distribution. And so it's kind of, we have to be on top of our game. You have to be on top of your game. And we're trying to make the clients' lives better off. So we work with large institutions still. We work with independent financial advisors. Independent financial advisors or financial advice is probably like 70%, 80% of our business now. And we do that all over the world. There's a kind of a developing market here in Ireland, which is really great to see. There's a pretty decent market in the UK, in Australia, in the US, a bit in Germany. But it's starting to build more as you look at it around the world, where you get this independent financial advice that is more client-focused than firm-focused.
Yeah, you can see tends to be the case. US, UK, then Ireland, we tend to be a little bit behind maybe, but I think we're getting there. I think the quality, the advice people are getting now is much better as a result. But you touched on people trading and buying stocks. You've a lot of research reports that we use, a lot of charts that we've robbed from you guys around active managers underperforming and the difficulty of active management to outperform in the long run when you look at fees, you look at different agendas, all those type of things. Why do you think that is? And how would you go about it if you were to do it a little bit differently than the traditional active manager?
Yeah, there's a tremendous amount of research on that topic, and it started in the 60s with a paper by a person called Jensen. And it was the very first time, actually, fund performance had ever been measured and compared to some reasonable benchmark, because it was the very first time that there was data actually available, even though there had been funds run since the 1920s. And so what it showed was most funds underperformed a reasonable benchmark, and at that time, maybe it was the S&P 500 or it was a capital asset pricing model or something similar. And the research since then has just reconfirmed that you can't disentangle luck from skill when it comes to people who are trying to outguess the market. So what does that mean? Like if you're saying that, oh, I know this stock is priced too high, I know that bond is priced too low, so now is the time to sell that one and buy that one. That approach generally hasn't yielded a good outcome for the end client for a few different reasons. One, the fees tend to be higher, and so net of fees and expenses, those more than eat any insight that person may have. Two, markets are very, very competitive. The beautiful thing about capital markets, and this is kind of an interesting thing about capitalism in general, especially as it applies to capital markets, is that the smarter you are and the faster you can trade, the more you actually have to share your information with everyone else. It's the most egalitarian system that you can construct, because the only way that you profit off that is you trade. And as soon as you trade, you share your information with everyone because you move prices. And so it turns out that process keeps prices fair. And so it's enormously difficult to say which is too high and which is too low. You should just accept them for what they are. It doesn't mean you can't outperform the market, it just means that you can't do it by outguessing the market. And then three, what you see is that active shops tend to be very concentrated in terms of their holdings. And so there's dispersion of outcomes is huge. You could get a terrible one, you could get a great one. And so up front, you can't tell which you're going to get. And so the data overwhelmingly suggests that it's just not the way to go for the end investor. When you look at dimensional, we have a lot of the good features of indexing. So low cost, broad diversification, low turnover, you know what you're getting. But indexing is very rigid and leaves money on the table. And by the way, that money comes out of your pocket. And so, and I can expand on that in a moment. And so there's kind of a happy in-between, because implementation really matters. Like, I don't think there's anybody here who runs their business who doesn't think that how you run your business matters to the success of your business. And it's the same when you're running a portfolio or you're managing money for someone. And so when you look at Dimensional's track record, over the past 20 years, there's two things I would point out. And I'll use the US fund example as an example. Number one, if you look at the funds we had 20 years ago, all of them are around today. Why is that important? Because when you look at the industry, about 40% are around today from 20 years ago. So I'll give you an example. If I were to be able to tell you that I have a technique that 50% of the time I can identify the winner of the Wimbledon tennis competition, I can do that every year, would you think that's a pretty good technique? What if I told you the data set only contained the two finalists? You'd say, that's pretty lousy, you're flipping coins. When you look at fund data and who's around today, the people that are around today are the people that have done well. All the funds that they've had that did poorly, they've shut down. You don't get that with Dimensional. Because when we launch a fund, we do it with what's right for clients and what clients are looking for. So 100% survivorship. And then you look at our outperformance, I'll take the equity side. Over that 20-year period, I think about 90% of the funds outperform. So no survivorship bias because they're all around, 90% outperformance. And the industry is like 15 to 20. And so it's not that we're trying to outguess market prices, it's that we're trying to control what we can control. I love this life planning that was mentioned earlier on. They're the things that you can control in life. We cannot control what the market is going to do, but you can control how you expose your portfolios to it and how you interact with it. And so it's just a different approach that's yielded over the long pull good outcomes for clients.
And then you mentioned indexing. A lot of people would say the opposite of active investing is passive investing, and passive investing is a term, and Paddy's probably laughing over that. I'm trying to get rid of that term out of our vocabulary. Passive indicates no decision making, right? But there is thousands of indexes out there, there's thousands of products out there tracking, so there's lots of decisions to be made, so passive is wrong. So indexing is, let's say, is the right term. So people that are, lots of people now are, I'll just go and buy the index, that kind of approach, and it's starting to grow and take a bit more, which is good. I think it's a good thing for retail investors here in Ireland, but there's lots of talk then of an index investing bubble, and it having a large reason as to why the mega cap companies are getting bigger, because there's just this flow of retail money in. Like, what's your answer to that? I think you said before indexing investing is naive. I've heard you say before. So looking at how would you tilt it, and do you think there is a bubble there?
Yeah. So a couple of issues with the amount of assets going into indexing now, and I'll give you an example. So everyone's familiar with the company Tesla. Some people probably like Elon, some people probably despise Elon, I don't really know. He used to be the darling, and now maybe he's not. But in any event, Tesla was added to the S&P 500 a couple of years ago, and it was added in December, kind of the middle of the month. And this had been announced well in advance of the index, including Tesla. And we have a fund in the US, it's a large company fund. And basically, it replicates the returns of the S&P 500, but we don't trade at the same time when the index is reconstituting. And so in that month, we traded Tesla a bit before it was added to the index, a bit after it was added to the index, and a bit on the day that it was added to the index. So we did it kind of around. The index managers all traded on the day it was added to the index, because the objective is, I want to deliver you the index return. And if I don't, I haven't done my job, because that's what's in the prospectus, that's what I'm telling you I'm going to do. That fund outperformed the S&P 500 by 8 basis points, so 0.08%. Now you might say that's not a big number, and it's an interesting number in that month. That's an estimate of how much it cost the index to add that one company to the index. You say 8 basis points, is that a big number or a little number? In the US, you can get an S&P 500 fund and you can pay an expense ratio of 2 or 3. So it's about 4 times the annual expense ratio of the fund over the course of a year spent on one day. So that's one of the problems with indexing. The more money that goes into indexing, the more everybody is doing the same thing at the same time. Do flowers cost more on Valentine's Day than other days of the year? Yeah. Now, this may not be the right advice for all the husbands in the room, but don't buy flowers on Valentine's Day. Buy them either a little before or a little after, because it's probably a more optimal buying decision. So I think that kind of price pressure is something that you see in indexing. In terms of it being a bubble or not, a lot of indexes are market cap weighted, so I don't look on that as the reason why some of the large growth companies in the US have gotten as large as they have. My view is that it's largely unexpected, in the sense that if you look at the Amazons of the world, the Netflixes of the world, the Googles and so on, and you go back 20 years, their success and their business model and what they were able to drive, I don't think that was expected by anybody. And so they did better than expected. They got rewarded with high stock prices, high returns. So that for me is not the index itself, but what I do think is that if you look at the S&P 500 or something similar, and that's your opportunity set, you're restricted in your opportunity set. Like 35% of your wealth in 10 names is not right. If you go global, if you have overweights to small cap companies, to value, so low relative price companies, price is low relative to some fundamental, high profitability companies, that sort of thing, you can go from 10 names 35% to 10 names 10%. So you're just getting a better diversified experience by going global and not being myopic on the Mag 7 or something similar. So there's definitely challenges with indexing. Just how they operate is, the world is not that simple. You can't operate under just a rule set that you can describe on one page. That's probably not going to be the optimal strategy for you in terms of getting all the market has to offer.
Yeah, and moving on to, I suppose, the market itself, you mentioned market concentration, so 7 companies, even the US now. Like a decade ago, the US was about 50% of global markets. Now it's around 70%. So whether we like it or not, we're more and more impacted by the US. So you're looking at market concentration, valuations at all-time highs. What's going on in the US politically, potential for wars. what's your views? What concerns you at the moment? And what is there anything there to be optimistic about? Any pockets of the market that might be some decent looking valuations?
Well, you should be optimistic about the market every single day, regardless of what's going on in the world. And let me explain that a little bit. Does anybody here sign up for a negative expected return when they're putting money in a risky investment? So you say, I might lose 20% of my wealth, but on expectation, I hope to only lose 10%. Here you go. No. So what do stock markets do? The price that you see stocks, bonds, and so on being traded for are predictions of the future. They're forward-looking. They're informed by the past, but they're forward-looking. And what they actually do is they go to a level such that what you expect to receive is a positive return. You may not get it because whatever is built into the expected price and then what actually happens may be better than what was expected, worse than what's expected, right? So you rarely get what's expected, but over the long pull, it actually works out that way. So if you look at the 100 years that you have US data for, the historical return has been around 10-ish. And if you look at how frequently it's within plus or minus 2% of the average, it's been like 6 years in 100. Usually it's something way higher or something way lower, right? So you don't get the average year on year, you get the average over the long pull. But it's always priced such that what's expected is a positive return. So like, for example, last year, if you look across developed markets in US dollar terms, Israel was the highest performing developed market. Now, if you were going into last year, you probably wouldn't have said, yep, Israel's the place to be. That's where I'm going to put all my money because they're having a war and there's protests about both sides all over the world and that's the place to be. Whatever, it had about a 30+% return in US dollar terms. So whatever was priced into those Israeli stocks, whatever happened was better than expected for those companies. And it's the same thing when it comes to stocks everywhere. So when people are worried about tariffs and they're worried about the economy and they're worried about Trump and they're worried about wars, and rightly so for something outside investing. But if you look at things like the VIX, what is the VIX? It's a prediction of future profitability. It spiked weeks ago. It moved from 15% to 25% weeks ago. It means that weeks ago, people were worried about, are we into more uncertain times? If you look at the return of the S&P 500 since about mid-February, it's been negative. Whatever you're worried about has already been incorporated in stock prices such that the expected return going forward is positive. So in that sense, you should always be optimistic about your return in the market. But people often confuse activity with accomplishment, and it's very important not to. If you want to be active, the things that you can be active around are all the things that were mentioned earlier on around planning. Should you be spending as much if the real economy is going to be going under some strain? You are the one that's in the absolute best position to know what impacts tariffs, et cetera, might have on your business, what opportunities it might have for your business, and does that mean that there's more uncertainty about employment and things of that nature for you? So you're definitely in the best position to know that. And those are the decisions that are actually helpful. But making decisions on your investment portfolio, that's not going to be helpful because your investment portfolio every day has a positive expected return. You may not get it. That's just part of life. The longer you're in, the higher the probability that you actually get that positive return. Even though the range of outcomes increases the longer you're in, the mean that the distribution actually goes up like time. The range increases like the square root of time. And so it's kind of a good trade-off. But that's something that I think that you should be optimistic about. Whatever is going on in the real world, there's plenty of shit there that there's lots of reasons not to be optimistic, but your investment portfolio can be just fine.
Yeah, I think there's kind of three ways nearly looking at it. You've got the market, or you've got the, what's going on politically and in the world, which affects our day-to-day. Then you have the economy, and then you have the market. They're not always linked. Things that go on in one area doesn't necessarily, negative things in one area doesn't necessarily mean negative areas for the market. So I have one more question, then I'll open it to the audience.
One point on that, Declan, which is, let's suppose I gave everyone here next year's GDP for every country in the world. And I give you that every year. So I always give you next year's GDP with 100% precision at the start of the year. Do you think that would help you make asset allocation decisions across regions? The answer is no. You can do that historically and look to see if you had that information, could you have outperformed the market? And the answer is no, because the market, they're interconnected in that the real economy is something that the market is considering. And it's saying, well, what's the real economy going to be like and how is that going to impact the profitability and the cash flows of companies? And it's reflecting that in prices today before it actually happens in the real economy. So that's why it's always forward-looking. And so you can't use information about this to outguess the market. So they're connected in some way, but it's in a way that you just got to trust that price discovery is happening within markets.
And for someone that is on the sideline, like one of the issues that we have now is inflation. I think we've been kind of badly trained. You know, inflation in Ireland went nowhere from 2008 to 2020, but we've seen 20% erosion of purchasing power in the last 4 years. You know, so cash being a safe haven has not necessarily been true. So for someone that is sitting on the sidelines, what's your advice for this year or for going forward?
Well, it goes back to something that you said. There is no such thing as a passive investor, because if you're sitting on the sidelines and putting cash under your pillow or under your mattress, then that is a decision, and it's a decision that will erode your purchasing power over time, so that in the future you won't be able to afford as much as you can today. And so I think that that's as risky a decision for whatever your objectives are as not investing. And I think that that's important to keep in mind, that inflation over time, and you can have spikes in inflation. You know, in the US, there's all sorts of measures that are forward-looking measures that are informed by market prices. One of them is called break-even inflation. Break-even in the UK right now is probably between 3 and 4. So that's what the market expects over the next 5 years. In the Eurozones, it's probably like 2 to 3. In the US, it's about 2 to 3, in that kind of a range. So the market is not expecting the same high inflation that we had a few years ago, but that doesn't mean that you can't be surprised. But what you want is you want your wealth to grow in real terms, so after inflation, so that you have more wealth over time. So I think that not investing, in my view, is way riskier than investing. Having the right plan, having the right asset allocation that matches your risk tolerance, and then being disciplined, so having a financial professional that can help talk you off the ledge, because there probably will be those times that come up where it's important to stay disciplined. And that, in general, is the thing that will grow your wealth faster than inflation. So that when you get to that third act, so we're not retiring around here, we're just getting to our third act, then you have enough money and more money so that you can afford your lifestyle. Because that's the reason that you take on risk. The only reason to take on risk in your investment portfolio is because you can't afford to do what you want to do without taking on risk. If you have enough money that you can afford to do all your philanthropic activity, you can afford your lifestyle, you can buy a house for your kids, you can do all of those things, then maybe you don't need to take on risk. But even then, for intergenerational transfer, you may want to. But that's the reason that most people take on risk, but you want to do it in a controlled manner, is because you'll have, on average, a better retirement if you do than if you put money under your mattress.
I think communicating that will be whether I succeed or fail in my own job, I think. So open to the audience. Any questions?
Could I ask, if you could give us a view of cryptocurrency, whether it's a good or a bad thing, if it's binary, and secondly, what do you see the risks with cryptocurrency in the future?
Yeah, so the question, just so everyone can hear, is cryptocurrency, whether it's a good or a bad thing, and then what are some of the risks of it in the future, some of the risks of cryptocurrency in the future. So the challenge with crypto in its current incarnation is that it's a currency that doesn't have stable value. And investing in currency typically doesn't have a positive expected return. So what makes the return of an investment positive? The expectation that you expect to get something more back than you put in. When you invest in the stock of a company and you hope that the market sets that price fairly, then you think that the company is going to create some profits in the future, create some cash flows. You're a residual owner of the company, and so you have a claim to those cash flows, to those profits in the future. And so you're investing something today for something more in the future. When you invest in a bond, it has a yield. It's paying you some interest over the course of while you hold the bond. And so you're buying something today, and maybe if it's a bond with zero coupon, you buy it at $90 today, it matures at 100 in the future, right? So there's a positive expected cash flow. Investing in currency does not have that. And so when you invest in crypto, what you're hoping is somebody will buy it from you for more than you bought it from someone else, which is not a great hope. It's also very volatile, so it's not a good store of value, right? So if you're using it to make transactions or pay for things with, and you have it going up and down like this, it's not a very good store of value. Plus, and this varies country by country, like in the US, you have to pay capital gains when you use your crypto if it's gone up in value since the time that you bought it. So on that front, I wouldn't say that it's something that you should have in your investment portfolio today. Now, how might that change over time? And I'll talk a little bit about blockchain in a moment, but how might that change over time? So we've seen where some exchanges, and we won't go into names, but they've been in the news and people have gone to jail, where they were loaning out the cryptocurrency, and as a part of the loan, you got a rate of interest. If you get more robust regulation around crypto and there is a good lending market to it, then you might say, okay, if I can loan this out and earn some rate of interest, now it suddenly has a positive expected return. It's a bit better regulated, so I have some understanding of the safeguards that are associated with how it's custodied and, can they commingle client assets and all those sorts of things. Then maybe there's a future for it. And there is a lot of regulation in the works in lots of different countries and probably coming. I'm not super optimistic about the regulation in the US on crypto, but we'll see. Largely because there's too many conflicts between the people who are creating the regulation right now and what the good outcome might be. But we'll see. Where I think that it has a lot of benefit potentially is making transactions less expensive. So if it turns out that using a crypto type currency, you can purchase things much less expensively than, let's say, using a credit card or using some type of a bank account or some type of debit card, then I think you'll see more adoption of those types of technologies. The problems are there is that as the blockchain grows bigger and bigger, so true security, the amount of energy that's required to verify those transactions becomes huge. And so what you have is you have a crypto exchanges where you have a node, and so all the blockchain security is largely gone at the node, but that's how you make it a bit more easy to transact. So we'll see how that technology develops. I think that a lot of the custodians, the banks, they're all playing with that technology. So it might be a very helpful technology, and crypto may be helpful once it becomes an actual currency, but as an investment, I wouldn't recommend it at this point.
Any other questions?
Hi, my question is in relation to sustainable investments.
Yeah.
So you talked about having the best outcome for your investors. So how do you balance that kind of drive for financial performance versus, investing in sustainable investment, and also just linked to that, having a global business? If you are looking at sustainable investment, how do you navigate the different sort of headwinds that you see in the US versus, selling investments to the Nordics, where people are very focused on investing in sustainable investments?
Yeah. So on that front, the way that I typically view it is more values-aligned investing. And the thing about values is they change all over the place. So, and they change through time. And so we don't try to take a position that this set of values is better than that set of values, which a lot of investors do these days. I think is the wrong view, especially as a fiduciary. Everyone has different values, and a value I value is working with people who don't share my values. That's okay, right? We can all get along. And so when it comes to sustainable investing, what we try to understand is, what are your values? What data exists that we can express your values in a quantitative fashion so that we can demonstrate to you very quantitatively that we've made a difference based on the values that you have expressed. So a very common set of values are people care about climate change and the impact to the environment, and that's common all over. And so what data can we get? Well, we can get data on different types of emissions across companies, scope 1, scope 2, and so on. And so we have lots of different data sources. We can express those very cleanly. We can say, okay, here's how we can take your values and express it in a portfolio. In terms of the trade-off between the financial performance and the value expression, if you start off very well diversified in something like a world equity or a core type strategy, you're starting off with 13,000, 14,000 companies. So that gives you more flexibility to exclude those that don't align with a particular investor's values and still have a good investment experience. We're pushing, I think, almost 20 years now of having sustainable and non-sustainable, mainly environmental focused in the definition of sustainable, because that varies across people in the US, and the returns of those are very, very similar. They're actually almost the same return over the 20-year period. And but you have a demonstrable difference in, you know, the scope 1 emission intensity, scope 2, potential emissions from reserves, those types of items. Navigating the political landscape, that's always tricky. But my view on that is that especially CEOs of companies should stay in their lane. And that view is not always popular. It certainly wasn't popular in the US in 2020, 21, 22. And Dave and I, you wouldn't believe the emails that we got from employees because we wouldn't take positions as a firm on events that were happening in society. My view is that we have folks who work for our firm who are more on the liberal side. We have folks who work for our firm that are more on the conservative side. We have clients who are on both sides. And so we stick to what we know, which is investing. And then we try to understand what people's values are, and they vary. We have funds that are more for Catholics, and they are all underweight healthcare. And then we have funds that are more for people who care about the environment, and they're underweight energy, and that's okay. So it's that's always been a good road for us to walk. And I think that it turns out to be the right road, because when you look at some companies now and the flack they're getting from governments, because there's no way that you can keep everybody happy. That's impossible. So if you're very, very vocal about these values are good and those are bad, then I think that you'll just, over time, end in the bad books with somebody. So we've been able to navigate that pretty well. But there are some investors who, unless the whole firm is expressing their values, they won't work with that firm. And if that's what your view is, okay, that's your view. We'll work with as many folks as we can, because we think that we can help a lot of people.
Thank you very much. Just want to thank everyone. We did promise we'd get everyone out of here by 9:15, so I think we're just about on time. Just want to thank Susan, Paddy, Casey, Carl and the team for putting this together, for Paul and Gerard for coming this morning, and for you all for taking time out and supporting us here, and hopefully you got something out of it, and at least got a breakfast as well. So enjoy the sun, enjoy the rest of your day, and we'll hopefully see you all very soon.